COVID has created unprecedented uncertainty in the investment landscape. What can investors do to hedge now during so much volatility in the markets? Joining me today to talk about this issue is Richard Laterman, portfolio manager at Resolve Asset Management. Richard, welcome back to the show. It's a pleasure to speak with you today.
Thanks for having me, David. Good to see you.
Let's set the stage for investors right now. Your company recently published a white paper in which you discussed returns this decade versus returns of the last decade. Now, we know that the S&P 500 has seen the longest bull run in history in the last decade. Can we see similar returns over the next decade?
Well, that is the billion-dollar question, and I think most investors are concerned about that. We see valuations in very, very high levels, nosebleed high, and bond returns as well, which is represented by ultra-low yields. So I think it's safe to say that whatever we've seen in the past decade will likely not happen again. It's very unlikely that we're going to see a next decade similar to what we've just experienced.
So I'll ask the viewers first. If you're a retail or institutional investor, what do you think are the major risks that will dominate your portfolio and your market outlook? Comment down below if you're watching this on YouTube. Richard, I'll ask you the same question now. Top 3 to 5 risks that you're watching out for.
Well, the upcoming U.S. election, I think, is definitely a risk that's on everyone's radar. The resurgence of COVID appears to be a huge variable there as well. And not only that, but the second order effects of that, how people are going to be behaving as we move forward. There are going to be further lockdowns, how small businesses are going to be behaving. So I think that's a major component of all that.
From what I've heard from analysts regarding the elections, it seems to me that the consensus is that either way, if we have a Democratic victory or Republican victory, either way, we're going to get a lot of stimulus, especially regarding infrastructure spending. Would you agree with that statement?
Yeah, I mean, it seems to be one of the only few bipartisan agreements in the U.S. seems to be that we need to spend more, right? The U.S. is going to be spending a lot more. And so I don't think the GOP is necessarily the fiscally responsible party any longer. So I think it's likely that we're going to be seeing spending. But one of the funny things is back in 2016, in the previous election, there was a market-friendly candidate, and there was the wild card, and then the wild card won. And then markets had a brief correction, and all of a sudden they were escalating into all-time highs, and the narrative switched. So even if you do get the call right, and you do bet on the correct candidate on winning, you can't bet that investors' perspectives regarding risk is going to continue to be the same as they were previous to the election. So these dynamics shift really quickly. And I think that's one of the toughest things, which is why I bring it back to having a portfolio that is prepared and is risk balanced, that can face any one of these environments. Like we're talking about having asset classes like gold and commodities and international equities and bonds as well. And they're structurally different. So they tend to benefit in different regimes, whether we have inflation or deflation coming down the pipe for whatever many shocks that we may experience. So I think having those is a great way to start and sort of protect the portfolio. I think most people, when they think about this uncertainty and a risk like the election, they're actually more concerned about protecting the portfolio rather than making a lot of money.
Richard, I'm going to guess that when you were talking about the wild card in 2016, you were referring to current President Donald Trump. Now, we've seen we're close to 4 years of his presidency now. We know what his policies were. We know what his tactics were. He's no longer a wild card. Would he not be considered just sort of a certainty going into the next 4 years?
Oh, I think the market perceives it in that manner. And I do think that right now the market has their favorite. That would be the incumbent. But I also think that the perception that a Democrat win would necessarily be bad for markets could shift quite subtly, as we saw in 2016. So that's sort of where I was heading in terms of trying to predict who's going to win, but not necessarily getting the call right, because how you thought markets would react to that win might be a shifting concept.
I've heard this before, which is the argument that a Democrat win would be bad for the stock markets. Can you break that down for us? Why is that?
Well, I think a lot of that hinges on this idea of breaking up big tech. I think that's one of the things that's been talked about. And so the antitrust cases that have been brought recently against some of the big tech companies. So I think that's one side of the equation. And I think the market does hinge a little bit on the idea that although it is a bipartisan agreement, they would perceive the Democrats as having a larger appetite for spending. And so what that spending would entail, there are ideas that have now entered the Overton window, like MMT. Some people like to call it helicopter money. And so if that does turn into policy, how that would bring about potentially some form of inflation, and what that would do for markets in general, and possibly a rotation away from the US 60-40 portfolio and into emerging markets, commodities, gold, things like that.
All right, so Richard, let's summarize right now for our viewers. If I were a retail investor with, let's say, $10,000, how should I be splitting out my capital right now?
Well, you might think about the risk parity as a core holding. That's how we see it. That could be anywhere between 30 to 60%, depending on your confidence on that type of strategy. And then from that base, you might consider having some of these edges that you can capitalize upon. For us, it's the pattern recognition, machine learning strategies that I mentioned, as well as the ability to go long volatility. So, I mean, if I were to summarize it, I would say being prepared by global diversification and risk balance, using specific edges, in our case, the ones I mentioned, machine learning and volatility.
But how can an investor, like a retail investor with $10,000, actually execute on these ideas? What instruments would they be using?
So we've bundled them all together in an ETF that we launched in July. It's called the Horizons Resolve Adaptive Asset Allocation ETF. The ticker is HRAA, or HRA, as we like to call it. And so it has that base of risk parity, as we like to call it, the do no harm portfolio. And then on top of that, we have an overlay of these specific edges and ability to trade volatility.
Okay, so what if I had $1 million? Would my risk tolerance change?
No, I don't think the amount of money necessarily changes. I think you would have access to different strategies at $1 million that you might not have at $10,000. But I think your risk.
Would I be more focused on certain risk over others if I had $1 million over $10,000?
No, I think the framework remains the same. The size of the portfolio should not be a role, but it does allow you to look at more sophisticated strategies. So we run a couple of hedge funds for qualified investors, so those would be available to you at $1 million.
Richard, I want to thank you so much for coming on the show today.
Thanks for having me, Dave. Thank you.
Thank you for watching Kitco News. We'll have much more for you. Stay tuned.